All right, welcome back to episode 3 of the Almost Friday show with me, Brian Dean. I'm a Master of Science in Finance, a former investment banker whose goal is to help you master the market. Every week around 12:30 on Friday, I do a 30-minute live stream. It's essentially a live investing seminar where I go over various topics happening in the market today to help you make better financial decisions and to answer any questions live that you have. If you have them, go ahead and drop them in the chat. Otherwise, we're going to get started. And we have a good agenda for this week. And we're going to start with my quote-unquote buy the dip indicator. This is an indicator that I use to decide when to buy into the market, into the S&P 500. You may have seen that year to date, the market is down 6%. We hit a low of, I think it was close to 15%. Yes, there it is right there. We hit a low of down 15% for the year. We've come off of those lows, and you may be wondering, is it too late to buy in? Could the market go lower from here? And that is what this indicator that I'm about to show you is designed to do. So we'll talk about that indicator, and then we'll talk about a few headlines that came across this week that I think are very interesting and that we should cover on the show. So to start with, for those of you who are new to the channel, new to me, new to this indicator, I use a very specific indicator called Bollinger Bands. What you're seeing on the screen here is what's called a candlestick chart, and I'm using Thinkorswim on the Charles Schwab platform. This is a 1-year chart with a weekly frequency, so each bar is 1 week of data. Obviously, red bars are when the price goes down, green bars are when the price goes up. And I'm going to expand this out to 3 years. I'll keep it at a weekly frequency, and we're going over to studies. We're going to add in our Bollinger Band study, and we are going to set this to a 52-week moving average because we want to look at the trend over the last year. And I am looking for the index to be 3 standard deviations below that average. Then I like to adjust the colors here. I like to make the middle line yellow, the lower line greens, which indicates when I will be buying into this market. And then the upper band is going to be red, and that should update our chart here. And you'll see that for this week, we got very close to this bottom line here. We have rebounded off of that. For those that may not remember, that is when Donald Trump announced a 90-day pause on his tariffs, and the market went up over 10%, I think, or over 9% in one day. So we are not yet at a place where I think we should be buying into this dip. Now, I want to caveat that with, obviously, you should still be invested. Obviously, there's that saying that time in the market beats timing the market. And the way that I handle this is I keep my whole portfolio invested in a mix of stocks and bonds. In my case, a percentage split right now between 60% stocks and 40% bonds, also known as the 60-40 portfolio. However, when the market gets below this green line down here and it closes at the end of the week below that price level, hence why we do these Friday streams so you know exactly when that happens, that is when I will either reallocate into, say, 80% stocks or 100% stocks, depending on my risk tolerance, or if I want to take it up to another level, I may introduce some leverage, either through a margin account or through a leveraged ETF, like SSO, which is a 2x leveraged ETF, or SPXL, which is a 3x leveraged ETF. Those all come with their own caveats. Of course, you should make the decision that is most risk appropriate for your portfolio, but sometimes I'll even go into 100% SPXL if I have a lot of conviction. For example, if I can push this out to, I believe 5 years should show us the last time this triggered, and we can keep this at 1 week. For example, the last time this triggered was we have June 13th of 2022, and you'll see that the market fell down to this low level here and closed for the week below that green line, and this would have been an opportunity to invest either in all stocks or in even a leveraged stock product like SPXL, and you can see that we've had quite a good run up since then. And then once we get into these upper ranges, of course, if you stay updated with the channel or on my newsletter, which I have a link down below, I also give tips and signals as to when to deleverage. When should we get out of that 100% stock position and go back to a more normal portfolio, whether that's a 90-10 split or a 60-40 split or so on. So that's the update for this week on the S&P 500 and my buy the dip indicator. Not time yet. And then I want to answer one more question. Do I think it could go lower? It could. Obviously, with this policy that we have, this administration that we have in place, it's very difficult to tell what direction the country is going with respect to global trade, with respect to deregulation and financial markets. In previous times, we have had these mix of up and down periods over multiple weeks. So the last time we had a downturn in the market and triggered this indicator, it took 1, 2, 3, 4, 5, 6. It took many months. It looks like about 6 months here. We go from January down to June. Yeah, it took about 6 months to go from top to bottom. Here, we are only about 2 months into this current market trend. So we have plenty of time, but I will be here with you every week giving you updates on when we trigger that indicator. So next, let's move into some headlines that I want to talk about. Number one is consumer sentiment. We got an update on the University of Michigan's index that measures consumer sentiment, and we can see that it is at a near low over the past 10 years. It is almost as low as where it was when this buy the dip indicator previously triggered in 2022. So while the market is trying to process which direction the economy is going, which direction our administration, this Trump administration, is going to take the US economy with respect to global trade, consumers are certainly feeling the pain. I know you may be feeling this on your end as well. You're seeing that prices may be starting to increase. I've seen many companies already start to put preemptive surcharges on their products to combat price increases as a result of tariffs. And even though many tariffs have not gone into full effect, there's still a baseline 10% tariffs. A lot of companies are dealing with the potential uncertainty for those tariffs to come back by introducing those surcharges, which is going to add to inflation. The next piece that I want to talk to you about this week is Google. And what was very interesting about Google is that Google seems to be in a place where many folks thought that Google was set up to fail. Google is the most popular search engine. However, it is at risk of being disrupted by AI. And there are a lot of folks who believed that with the rise of ChatGPT and more people getting information from these AI chatbots, that companies like Google that rely on search traffic would stand to lose, would be disrupted by these chatbots. However, if we pull up Google stock, we can see that they far surpassed earnings expectations, and over the last week, they're up 8.4%. I talked about this on my Twitter feed previously. If you want to give me a follow there, my username is randomlybrian. I'll pull it up here quickly, x.com/randomlybrian. And I guess I have to sign in on this window, but you can see here it's just randomlybrian, all one word. And here's my thesis for Google. While it is true that these AI chatbots are consuming a lot of user search traffic, a lot of folks like yourself and myself may be using these chatbots to get information, I at least personally still use Google in my day-to-day search, what I want to call this, in my search lifecycle. If I want to find a piece of information, sure, I might start with ChatGPT, but I also know that ChatGPT is prone to giving me incorrect information, and so I will often confirm that with a Google search, or I will use ChatGPT to start me in the right direction, and then I will transition over to Google when I want to actually find, say, the company's website that I'm looking for more information on. The other thing that I want to add too is whenever you interact with ChatGPT, it'll perform a search. It'll perform a search function. It'll do the search for you. And that is also going to add to search volume with respect to Google. So Google saw a strong increase in search volume. Google also has their own AI agent called Gemini. And I don't know if we'll find it in this article here, but I was reading that Gemini now has about as many active users as ChatGPT does. I believe it was 500 million? I think it was around 500 million. So it was at least no surprise to me. I currently am not invested in Google stock. I'm kicking myself a little bit for not having invested in it prior to their earnings release, but that's just how it goes. And my investment strategy does not include Google at the moment. So that's a quick update on Google, which is the reason I thought that was important is because we have a really large tech company that we were expecting, we as in the mainstream media, I would say, was expecting to be disrupted by AI chatbots. And it turns out that it's completely the opposite. Now, some of you may be watching this and wondering, do I think Google is a worthwhile investment? I think over the long term, Google is a tough company to bet against. I do not think Google is a bad investment. And anytime that they have pulled back this amount from their recent highs, we're currently, let me pull up the exact value for you. We are currently 20%, 21% below their recent high within the last year. If you just look at their long-term chart, anytime someone would have invested in Google when they have come down from their high by 20%, would have been a good investment in the long run. If you had bought Google here when it was down 20% in 2022, you would now be up 40% on your investment. During the COVID recession, if you had bought, say, in the middle here, you would be up, what is this number? You'd be up 152% on your investment. So do I think Google is a good investment? I think at this level, yeah. If you're thinking about holding it for the long term for, say, 3 to 5 plus years, I think Google is a fine investment. I don't think that they have the risks that a lot of folks attribute to them via being disrupted by AIs like ChatGPT and Perplexity and even XAI, which Elon Musk is now running. So I think they would be a great long-term investment. So that is the update on Google. Next, we also got an update on the housing market. And I know, at least for myself and many of my peers who are in, say, late 20s into their 30s, maybe even in their 40s, and they haven't become homeowners yet, this may be some big news that you'd be interested in. So you can see here that sales of existing homes plunged to their slowest March pace since 2009 in warning sign for spring housing season. Now, this may be good news if you think that housing prices are going to come down, or if you've been waiting for them to come down so that you can get into home ownership and become a homeowner, which I know is a big part of the American dream and a lot of folks feel like is unattainable these days. However, I also want to sprinkle in a little bit of bad news in terms of why I don't think housing prices are going to come down as quickly as you might think. The reason for that is that supply is still low relative to historical levels. I don't know if they're going to show it in this article because a lot of times these articles like to take just one angle. They'll show just a single metric and not the other metrics in context. But let's see if we can pull up housing inventory. Housing inventory, United States. And see if we can get a 5-year chart here. So we can see that, and again, this is only 5 years. I wish it would go a little bit farther. Let's see if we can get it from the Federal Reserve. Here we go, 10 years. And this goes back to 2015. So while housing supply is, this looks like percent change. Let's see if we can get I need the level of homes for sale. Here we have 5 years again. Yeah, I wish we had 10 years. Let me go back to this website here, this Y charts. Okay, so this is a very important chart because you can see, number one, the annual seasonality of how many homes are on the market. And while home inventories have increased year over year, they're not at super high levels compared to where they've been previously. And so for this reason, I just don't think that housing supply is going to outstrip demand. There's going to be a very large supply and demand factor that factors into whether or not housing prices are going to come down. And while sales may be slowing, I think there's going to be enough pent-up demand so that even if prices go down just a little bit, say 2 to 5%, then you're going to get folks who have been waiting to buy into homes. They're going to jump on that small decrease in price. The demand is going to come in, soak up that supply, and keep prices elevated. And we can see this with median home prices in the United States, which are now at, I think, pretty historic highs. Here we are now at, oh my gosh, I haven't checked this in a while. So we are now at over $400,000, $416,900 for the median price of houses sold in the United States. And if we look over a 10-year period, you can see that while prices have come down a little bit, they are still at this elevated level, not far off from their Q4 2022 highs. So while you may have seen some headlines, I know there were other creators online that were taking the opposite stance that I did. They're looking at the pace of existing home sales go down, and they're saying that this may mean that the housing market's going to crash. I simply don't think that the housing market is going to crash anytime soon. We're not going to see a 10 to 15 to 20% drop in housing prices. I would love to be wrong. I am a real estate investor, and I would love to see real estate drop 20, 30, 40, 50% like it did during the 2008-2009 recession. I just don't think that that's going to happen. I think we may see potentially a small pullback, perhaps to the 350, 375 range, but I just don't see us dropping too much from this level because there is still so much pent-up demand for housing in the United States. And the last piece that I wanted to mention is I have this long-standing hypothesis that we are potentially already in a recession. We just don't know it yet. And I think that for a few reasons. Number one is that unemployment continues to be on the rise. And something that I pointed out in one of my videos on the channel is that this has been a persistent trend going all the way back to 2023. So even putting aside the fact that we have uncertain trade policy, we have, especially with respect to tariffs, unemployment was already on the rise going into 2024. You can see that we went from a 3.4 unemployment rate at the lows up to a 4% plus unemployment rate, and that has not come down at all going into 2025. And in my view, we can expect that to continue going up even further. The other piece that I want to show is inflation, which is another leading indicator of recessions. Whenever inflation increases, that can reduce consumer consumption, leading to a recession. And if I can find the right chart, PCE inflation, Fred, I want to find the percent change. Let's see if we can find it here. It's just the index. Okay, here we have the price, the percent change. So what you're looking at is personal consumption expenditures. This is different from CPI, and this is the metric that the Federal Reserve prefers to look at when measuring inflation. The Federal Reserve wants to see this at a 2% level. However, it has remained unfortunately above their goal. We got to 2% down in Q4 of 2023, but we've been averaging anywhere between 2.5% to 3.5% since then. And that is after this surge that we had of 5 to 6% inflation year after year coming out of the COVID pandemic. So prices have gone up, they've stayed up, they've continued to go up from those high levels even more than the Federal Reserve would like for them to do. And because inflation is stubbornly high, that means that the Federal Reserve is not going to be able to lower their benchmark interest rate anytime soon. I know there were some narratives that were going around in the news that other creators were putting out there that the Trump administration was trying to crash the economy on purpose and therefore force the Federal Reserve to lower interest rates, which would be somehow good for the economy. Spoiler alert, low interest rates by themselves in a vacuum are not necessarily a good thing, but that was the narrative that was going around, and that is just not going to happen as long as inflation stays stubbornly high. And when you have this combination of high inflation, low growth, and rising unemployment, this is what we call in finance and economics a period of stagflation, which is just a combination of inflation and stagnation. Usually, when you see unemployment go up, that means that there is less money for consumers to spend. They lose their jobs, they lose their incomes, they're not able to spend as much money. Companies then see that reduced demand and they need to decrease their prices to try and get more sales, to get people to spend money, because obviously they're not making as much. And that is where you'll see prices start to come down. You'll see deflation, and you'll see that coming out of the 2008-2009 recession, inflation was stubbornly low as the economy recovered from that recession. And however, we are seeing the exact opposite. We are seeing unemployment start to go up, and we are seeing inflation remain persistently high. And this would actually force the Federal Reserve to not lower interest rates, but to at least keep them where they're at today and potentially increase them, because they have to choose between one or the other. They have to choose between helping out unemployment, which would mean lowering interest rates, or combating inflation, which would mean increasing interest rates to reduce demand. And in my view, if the Federal Reserve is going to pick one or the other, they're going to go with inflation 10 times out of 10. they have two mandates, both of which are unemployment and inflation, stable prices. But what they are most concerned about is what's called a runaway inflation. When you get this persistent increase of inflation all the way up into 7, 8, 9, 10%, and costs are just spiraling out of control, because higher costs lead to unemployment, whereas unemployment doesn't necessarily lead to higher inflation. So this is creating a concerning environment for me as a market participant, as an investor, as someone who needs to buy groceries every week, that I don't think the Federal Reserve is going to lower interest rates in the way that many people think that they will. And as a result, that is the framework for why I think we may in fact already be in a recession. Oftentimes recessions are called in hindsight. The data is reviewed backwards, and then we call a recession at that point. We're not going to say, as of today, we're in a recession. We're going to say, okay, based on the data as of about 3 months ago, that's when the recession started, and we are currently in it. And so that's my view on the economy as of today. And then there's the so what. So how should I be investing? In my view, there are a couple of ways, and I'm going to take you to my YouTube channel because there is a video that I have, or a series of videos that answers this perfectly. Just look up Brian Dean Finance, and I'll explain what's in the videos instead of just showing you the thumbnails. But if you want to go learn more, you can check out this playlist here, Recession Investing, starting with how I'm building a successful investment strategy, excuse me, in 2025. And the 3 key points there that I mentioned were focusing on your personal finance. If we're going to go into a recession, my philosophy is that you should be worried less on trying to pick the best investments, and you should be worried more about your personal finance, making sure that your household budget is prepared for higher prices and potentially loss of income, whether that's losing your job or even getting a pay cut at work. I know that concept may seem kind of foreign because we've been in such a strong economy for a long time, but that could be either losing your job or a reduction of your income, or having to find a new job at a lower income. So step 1 is making sure that your household budget is prepared for that, because picking the right investments doesn't matter if you suddenly find yourself out of a job and you are in the red with your budget. You are hemorrhaging cash every month, having to pay for your mortgage, your groceries, your subscriptions, any other costs that you've added to your personal budget, and you don't have enough income coming in to cover those. And your investments are not going to save you. At some point, you would need to liquidate, and that's what can lead to further declines in asset prices. It's just not a good situation to be in. So step 1, personal finance, personal budget. Step 2 would be making sure that your existing portfolio is risk appropriate for your goals. What I mean by that is if you are usually invested in, say, an 80-20 portfolio, your stocks may have gone up so much over the last 2, 3, 4, 5 years that you may now have a 90-10 portfolio. You may be more exposed to stocks than you otherwise would want to be. And if you do think that we're going into a market downturn, you may want to get more exposure to, say, bonds, more stable assets like fixed income, or into gold. Or even high yield treasuries. So you may want to increase your allocation maybe to a 60-40 portfolio. And then the last point is going to be trying to pick the right stocks, trying to understand when is the right time to get back to that higher leverage portfolio, away from something safer like a 60-40 and into more stocks. And that's where I would pull you back to my buy the dip indicator, which is, again, I'm going to give you an update here every week on Friday between 12:30 and 1. And when the S&P 500 closes below this green line, as it did over here back in 2022, and as it's done in every other crash that I've seen going back to 1938, that would be the time to get in. So make sure to stay tuned every week, 12:30 p.m. Friday here on the channel, and you'll know exactly when I'm buying into this market. With that being said, I'm going to end the video a little early. We've covered everything that I wanted to cover for this week. If you're watching this after the recording, thanks so much for watching the video. I hope you got a lot of value out of it. Covered a lot of topics here. Would love to see you in the next live. And with that, I will see you next week. Bye.